All right, example 1.4. Now what we're going to do is we are including an asset on which allowances were claimed. The rest of it's the same. The only difference between example 1.4 and 1.3 is we have this shareholder's loan in there again, and that's all just to confuse you because shareholder's loan is liabilities and we are looking at equity. Okay, so guys, same situation here. The capital profit, 4 million of that is contributed tax capital, 1 million of that is a reserve, the same with the rest. So I'm just going to show you quickly. The start's the same, everything is exactly the same here. I'm not going to talk about that. Let's talk about the differences. Now, what happens in number 3 here, two things. The first thing is they sell a piece of land, that's the same piece of land, had a cost of 3 million, sold for 7 million rands. I'm just reminding you, so the accounting profit on the land, selling price, less carry value, gives you a profit on disposal of 4 million rands. Right, for tax, proceeds, less base cost gives us a capital gain. Right, now, next one. A manufacturing machine that had a cost of 10 million rands and an accumulated depreciation balance of 7.2 million rands. This machine was purchased in 20x6 and the machine was sold for 11 million rands during the liquidation process. Okay, so first we go now. This is our accounting profit. Make sure you see that. Accounting profit. The machine, so we'll have the selling price less the carrying value. And what is the carrying value? It is the cost less our accumulated depreciation. Right? How much was this sold for? They tell you it was sold for 11 million rands. They tell you it was purchased for 10 million and had accumulated depreciation of 7.2 million. So 10 million is the cost, less accumulated depreciation of 7.2 million. That gives us a carrying value of 2.8 million rands. So 11 million minus 2.8 million gives us 8.2 million rands. So if this is just a calculation of the total, it'll be 4 million plus 8.2 million rands. That is what we would have in our income statement, our statement of comprehensive income, 12.2 million rands profit before tax. So guys, accounting profit, sale of land, sale of machine. Let me actually keep it split like that just to make it clearer for you. 4 million and 8.2 million. So the sale of the land, 4 million. Sale of the machine, 8.2 million. Now let's do the tax liability. So the first thing is the sale of the land. Proceeds less base cost gives us a 4 million rands in CDT. Okay, we're happy with that. Then we have the sale of the machine. Okay, the machine had a cost of 10 million rands. They tell you it was brought into use in 2006. 2006, 7 and 8, remember? Because this was at the end of 20x8 and this was liquidated on the 2nd of January. So the company did not trade at all. That's just important for you to see. So let me explain why. So when we do this now, it's cost less section 12C. So 20x6, we would have claimed 40%. 20x7, we would have claimed 20%. 20x8, we would have claimed 20%. And 20x9, the current year, we would have claimed null because it was not used in the production of income. So 4 million rands, 2 million rands, 2 million rands, and null. Don't be caught out there. That gives us a tax value of 2 million rands. Okay, tax value. Then we have our selling price limited to our original cost. This asset was sold for 11 million rands. Our original cost was 10 million rands. So what do we use? The 10 million rands. So guys, this is all normal. This is 8 million rands as a recoupment. Okay, so that gets included, our 8 million rands. Then we have to calculate our capital gain. Proceeds is 11 million rands minus the 8 million rands gives us 3 million rands. The base cost is the cost less allowances. The cost is 10 million. The allowances is the sum there, 8 million. Gives us 2 million rands base cost. That means we made a million rands capital gain. And that goes into my CGT column. Now I add up everything in my CGT column, which is a million rands and 4 million rands. From the land as well, 5 million. Okay, so my aggregate capital gain. Do we have any capital losses brought forward? None. Okay, our inclusion rate is 80%. So that means our taxable capital gain is 4 million rands. That 4 million rands goes into my rands column. Now we add up everything in my rands column. There's a recoupment of 8 million and a 4 million rands taxable capital gain. So that gives me a 12 million rands taxable income. The tax calculated on that at 28%. $3,360. So our tax liability 3,360. All right. So guys, that part what we just did now. Look at my accounting profit. Look at my calculation here. Pretty short. Look at my tax calculation. Okay, a lot more. This is where the majority of your marks lie. And nothing in this tax calculation is new for you. Nothing at all. If it looks new, it means you have missed the concept previously when we calculated recoupments or capital allowance or something like that. Please go back. So this gives us 13,340 and 4 million. All right? So our concept, if the shareholder is a natural person, they'll pay dividends tax of 20%, so 2,668. If it's a company, they won't pay anything. All right, now let's go and do our shareholder. So what happens to the shareholder? So the shareholder receives a dividend of 13.34 million. That full amount is exempt. Right? The company then receives, the shareholder receives 4 million rands for the sale of its shares, of his or her shares. The shares had a base cost of 6 million. Remember, we're looking at the shareholder here, gives us a capital loss of 2 million. Now we go through our story again. If this is a natural person, we look at our paragraph 19 dividend stripping. Was it 100% exempt from income tax? Yes. There we see it. Was it 100% exempt from dividends tax? If it's a natural person, no, because they have to pay dividends tax. So then my exempt dividend is null. If my exempt dividend is null, then I can claim the full 2 million rands capital loss can go into my CGT column. There we go. Now I change this. It's not a natural person anymore. It's now company. Okay. Was it 100% exempt from income tax? Yes. Is it 100% exempt from dividends tax? Yes. So the dividend amount of 13,340, that is my exempt dividend. So how much of the 2 million exceeds 13.3? Nothing. Right, and that's it then, again. So you can see, guys, very, very simple in reality when you start building it up like that. And we'll see a little bit more of that in a second when we look at our next question. We're just going to build up from this.